With high interest rates in 2023, the market has been hammering the REIT sector with big names down, such as Alexandria Real Estate down 28%, Mid-America Apartments down 22%, some popular community favorites of Realty Income down 17%, Triple N down 16%, Extra Space Storage down 11%, Vici down 10%, as well as PSA down 5.5%, with a lot of names even down to a greater degree. With these drops brings a lot of opportunity for 2024, where we'd expect a lot of these REITs to rebound. And in today's episode, we're going to take a look at 4 of our favorites that we expect to bring in big dividends in 2024. We're going to look at the historical performance of these companies in detail. We're going to look at their dividend safety, some very important financial metrics. And as always, we will run them through our valuation model, telling you what we believe our margin of safety to be, as well as our acceptable buy price. These are companies that have safe or very safe dividend yields above 4%, and are looking to grow continuously on both their dividend as well as the sales on top. So let's start off and take a look at our first undervalued dividend REIT, which we do expect to be big in 2024. And we're starting off with MAA, Mid-America Apartment Communities. Now, this stock is down 22% year to date, trading right there at its 52-week low, offering a forward yield of 4.61%. Now, investors who have been holding this company over the last 10 years would be up around 98%, and it is had a peak at around $220 at the back end of 2021. So it is nearly half the price of its all-time high, and there is a lot that we do love about MAA. Jumping straight into the financial metrics, what we do see a dividend safety score of very safe 97, a yield of 4.6 with a very small market cap around 14 billion, making it a large cap company. Now, when we took a look at some key metrics for those that believe a recession is inbound, they did maintain their dividend during the 07-09 recession, had positive sales, which is always good to see, and that was above the average growth of companies in the S&P, which was negative, and it had a return of negative 51, slightly outperforming the S&P's negative 55%. One thing I do love about this REIT are those dividend increases, 12% that we did see in December 2022. Always good to see double digits, but at a minimum, I advocate 4% or more on the channel to keep up with inflation. 6% over the last 5 years, again, which is still positive to see, but over the last 20 years, slightly poor, but you are still at least keeping up with inflation at 4%. And if you are taking on a yield of 4 to 5%, that is still a very decent performance over the long period. Now, they have been paying increasing dividends over the last 12 years. And when we take a look at that dividend yield theory, remember, what it states is that a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation here. Likewise, forward P to FFO below the 5-year average for our second sign. And when we compare it to the real estate P to FFO ratio, it is slightly higher at 14.4. And it is trading at the 52-week low. It is key to mention that 52-week low never signals undervaluation, so do bear that in mind. Now, for REITs, we stick with the adjusted funds from operation payout. Below 90% is our preference, and it is very positive to see that for the large part, Mid-America Apartments is below 70%, which is why we can see those double-digit increases. And given 2022 was at 61%, with 2023 expected to be in the mid-60s, I would expect another nice high single to low double-digit increase from them this or next month. Adjusted funds from operation, very important to see growth on this graph. 433 in 2013, nearly double that in 2022 at 767, with the mid-8s expected in 2023. Very positive to see for this company. Now, sales growth, remember, for REITs, we look at 5 to 10%, and on average, they have been hitting that. With the last few years, we see some slight inconsistencies, 2% in 2020, before picking up to 6% in 21, with some mid-double digits in 2022. Now, total sales, how does that reflect numerically? Well, 64 or 640 million in 2013, 2 billion in 2022. And one thing it is important to note with REITs, we do mention it on the channel quite regularly, they do issue shares to fund property acquisitions, as the majority of their essential income that they generate is paid out as dividends. But it has been good to see that MAA over the last 6 years has barely increased those shares outstanding, which is a positive for investors. Now, ROIC, remember, 3 to 5% is what we look at for REITs, 10% or more for other companies. So it is positive to see. It does give us faith in management and their ability to effectively allocate their capital. So the last 4 to 5 years between 4 to 6% is a very nice plus for investors. Operating margin 25% consistently, very positive to see. And that all important net debt to EBITDA, which if you're a regular viewer, you know it does directly correlate to the dividend safety. Below 5.5 is what we aim for REITs. And what this essentially shows is the number of years it would take the company to pay off all of their debt net of cash on hand. 2022 sitting at 3.74, very positive to see, with 2023 expected to go lower. Now, in terms of the valuation for Mid-America apartments, what do we see? Now, typically, you know we do in-depth reviews on the channel. We run through every single model: Graham's valuation, REITs multiple valuation, the dividend discount model, the discounted cash flow model, but we'll jump straight to the output tab to keep things nice and sweet. So we have the 3 models that we use. Now for REITs, we typically ignore Graham's valuation. It isn't appropriate for REITs when you want to calculate them and value them. We get a intrinsic value of MAA at $153. Now the current price is sitting around $121, and a margin of safety that we typically start off with, 10%. Remember those 3 key factors: wide moat, strong financial metrics, and good forward-looking data. So with a 10% margin of safety, it is an acceptable buy up to $138. At 15%, a buy up to $130, and at 20% margin of safety, you would be looking at the current trading price. Now, Wall Street, they believe the share price to go up slightly higher than our intrinsic value. So not only on our estimates are you getting a 20% margin of safety, but you are also getting some nice upside per Wall Street. Now, moving on to the second REIT, we have EXR, Extra Space Storage. Now, year to date, like most of the REIT sector, they have been hammered down 11%. They are trading towards the mid to lower end of the 52-week range, currently offering a yield of just over 5%. Now, investors who have been holding this self-storage company would be up around 207%, and we can see it did peak towards the beginning of 2022 at around $226, again nearly half of the current trading price, which is very, very opportunistic for those investors who do believe that REITs will bounce back. Now, in terms of Extra Space Storage, what we can see, a dividend safety score of 80, making it safe, and a market cap of $27 billion. Now, in terms of their key recessionary metrics, they did in fact, unfortunately, cut the dividend during the 07-09 recession. They had around flat sales, remember though it was above the average growth, and they did slightly underperform the S&P, which was down negative 55 versus EXR's negative 66. Now, another very nice dividend growth company, 8% in February of this year. Very nice to see, well above that minimum inflation rate we target. Double digits over the last 5 years, double digits over the last 10 years at 22%. Very, very positive. And similar to MAA, they have been paying increasing dividends for around 13 years. Now, dividend yield theory states that this company is undervalued, as we can see, 5.07% versus the 5-year average. Likewise on the P to FFO ratio. And when we compare it to the sector P, it is slightly higher at 16.4. Now, looking at the payout ratio, and remember the 8 FFO payout, it is sitting at 67%, so it is significantly lower than the 90% for REITs, which does make me believe that if it continues to be like this, we will expect a nice high single digit or low double digit increase in the dividend in February of next year. Likewise, adjusted funds from operation, we can see some data not shown, but over the last 10 years, it has gone from $2.12 to $8.90 over the period, which is very positive to see that growth for the investor as their adjusted funds from operation is generating more each year. Sales growth well above that 5 to 10% we look for the majority of the period, with 2021 and 2022 showing some very strong numbers. Now, when we look at that numerically, how does that compare? Well, 530 million of sales in 2013, around 4 times growth to the period of 2022 at 1.97 billion. Another company, EXR, that doesn't dilute your position very rapidly as a shareholder, gone from 113 million in that to 142. For those that do want to see companies that do increase this very rapidly, do go check out my latest review of Realty Income, where we dissect the shares outstanding that does increase very rapidly and dilute your position as a shareholder very quickly. Now, ROIC, very positive to see, above 3 to 5% that we look for REITs. In fact, targeting those normal companies at around 10% or more, with the last 2 years at 9%, very consistently in the high single digits, very positive. This is a very, very strong company. And operating margins very high at around 50% consistently over the last 10 years. Now that all-important net debt to EBITDA does factor that dividend safety. Remember, 5.5 is our target. 2022, it is around 5.47, so it is straddling the threshold that we like to see. And 2023 expected to come down below that 5.47, so it does give us faith in management's ability to continue to pay those dividends. Now looking at the analysis, jumping straight to the output tab. And remember, the intrinsic value is just the average of these three models. And as always, if you're enjoying the content, do hit that like button, do smash it. In fact, hit that subscribe and bell button so you are continually notified of these videos. And for those that are interested in grabbing a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. So we have the current price of EXR at $128. Now margin of safety, as we start off with on the channel at 10%, it would be a buy up to $143. 15%, it would be a buy up to $134. And if we go to 20%, it would be a buy around $1 short of the current trading price. So you could argue you are getting around a 20% margin of safety at around $127. Now, what are Wall Street saying? Well, they believe the share price to go up to around $142 over the next 12 months. So they do see some nice upside with extra space storage. Now, jumping on to the third REIT that we are looking at, which is discounted and undervalued, we are looking at PSA Public Storage. Now, this is down around 5.5% year to date, trading towards the mid to lower end of the 52-week range, and does offer a yield of 4.66%. Now, investors who have been holding this company over the last 10 years would be up around 76.5%, and we can see, like many of the other REITs, that did peak at around $400, which is nearly half the current trading price. Now, a few stats about public storage straight away. Very strong dividend safety at 96, making it very safe. Market cap of 43.5 billion, making it a large cap company. And when we take a look at some recessionary metrics, they did maintain the dividend during the 07-09 recession. Negative 9% sales, so in line with the S&P, but a slightly better performing share price at negative 38% versus negative 55%. Now, dividend growth, 50% increase in February 2023, which is fantastic. They didn't increase it on average over the last 5 years, and over the last 20 years at 8% per year. So when we take a look at the graph, we can see there have been some significant years where they in fact kept the dividend the same, but did increase this year at 50%. And therefore we do see essentially this will be the first year of consecutive increases. Now, dividend yield theory, we can see it does seem to be undervalued, 4.63% versus 3.44. Likewise, that forward P to FO below the 5-year average, and it is significantly higher than the real estate comparison. Now, when we take a look at that all-important payout ratio, we do see it below the 90% again that we like to see as investors for that comfort in that dividend safety, with the last 2 years below 70%, although it is expected to climb up in 2023, but still below that 90% target. Now, A to FFO pay share ratio, what we see is 7.17 in 2013, 13.6 in 2022, so nearly doubled that, which is always great to see as an investor, and is expected to go to the mid-14s in 2023. Now, sales growth 5 to 10%, it is what we see on average over the last 10 years, and it is positive to see those double-digit increases over the last 2 years, which, as we can see, translates to some strong growth over the last 10 years. $2, or in fact $2 billion worth of dollars sales in 2013, 4.24 in 2022. Another great company, as we can see here, that doesn't dilute shareholders, and their shares outstanding have remained relatively flat over the last 10 years, with around 3 million worth of shares issuances. ROIC, probably the best we've seen so far on the channel in terms of REITs. We can see at 10% or more, and remember, for REITs, the average we do typically tend to see is 3 to 5%, so that is very, very positive. Again, operating margins on average 50%. This is incredible so far, and this is even more beautiful when we look at that net debt to EBITDA, well below that 5.5. Yes, it has increased to 2.82 in 2021. It is come down in 2022, although it is expected to increase slightly, but well below that 5.5, signaling the company does have a nice and strong balance sheet. Now, moving on to the valuation of PSA, and remember, if you do enjoy the content, smash that like button. It really helps the channel grow, puts the video out to other investors in the community. And don't forget, you can grab a copy of the valuation model in the comments below. So the intrinsic value is coming to $308, and we do start off with a margin of safety at 10%. Increasing that to 15%, it is a buy up to $262. And at 20%, you'd have to wait to 246. So right now, on PSA, based on our estimates and judgments, you are getting a 15% margin of safety, with Wall Street expecting the share price to come all the way up to $303, slightly lower than our intrinsic value over the next 12 months. This brings us to our fourth and final discounted REIT, Alexandria Real Estate. Now, this has been hammered year to date, down 28%. Right there towards its 52-week low, with a yield just shy of 5%. Now, investors who have been holding this company over the last 10 years would in fact be up 63%, but like the other REITs, a very similar story. At the beginning of 2022, it did peak at around $220, again nearly down half, or in fact more than half of that high that we saw. Now, taking a look at the dividend safety, 76, so it is safe with a market cap of 18 billion, making it a large cap company. Now, recessionary metrics, they in fact cut the dividend during the 07-09 period. Recession sales, negative but slightly higher than the average growth of companies, but it did have a worse performing return versus the S&P's negative 55. Now, dividend growth fairly stable, 5% over the last full year, above that inflation rate, 6% over the last 6 years, and in line with inflation over the last 20 years, which isn't bad in my opinion if you are getting a fairly strong yield to begin with. Now, in terms of increasing dividends, they have been increasing those over the last 12 years, similar to the first two REITs we analyze on the channel. And dividend yield theory, as we can see, again, undervalued at 4.8 versus 2.69. And likewise, the forward P to FO tells a very similar story. And we can see it roughly in line with the sector P to AFFO. Now, in terms of the payout ratio, remember below 90%, it has been below that continuously. In fact, below 80%, with 2022 at 77% and 2023 expected to come down even lower. Now, when we move on to the AFFO per share, $4 in 2013, $6 in 2022. So we do see some nice growth over the last 10 years, and it is expected to go higher in 2023. Now, sales growth, again, very strong, nearly double-digit increases every single year over the last 10 years. So that is always positive as an investor to see that top line increasing. And numerically, it's gone from 630 million to 2.59 billion. One thing to note, though, this has been one of those that does issue shares a lot than the others that we have compared, going from 68 million to 162 million in 2022. But do bear in mind that this is typical for the REITs that you do see. But again, it does come down to investor preference as whether or not they like to invest in companies such as Realty Income that do dilute shareholders quite rapidly. ROIC, pretty much in line with that 3 to 5%. It did drop over the last few years, so it is one that I would keep an eye on, but it is roughly in line with what we would expect. Operating margin, one of the lower ones we have reviewed, around 25 to 35%, but that is still strong for a REIT. And when we come to the net debt to EBITDA, whilst 5.5 is the maximum we look for over the last 10 years, it has been pretty much over that. But the positive is that it has started to come down, with 2022 at 5.86%, 2023 expected to come down slightly lower towards that 5.5 that we look for. Now, Alexandria Real Estate, when we do take a look at the valuation, and remember, intrinsic value, purely the average of the models. And don't forget to hit that like button if you're enjoying the content, values being provided, and drop your comments along as we go with the video. Now, when we take a look at the margin of safety, remember the starting price at $103. 10% margin of safety would be a buy up to 122. 15% margin of safety up to 115, and 20% at around 108. Now, if we pushed it to 25%, you'd be looking at a buy at around $102. So you are locking in around a 20 to 25% margin of safety. Now, Wall Street, what do they forecast? Well, they believe the share price to go even higher than our intrinsic value. So they see some strong upside to the current trading price at around 30 to 35%. So for ARE, you would be locking in, based on our estimates, around a 20 to 25% margin of safety, with around 30% upside based on Wall Street analysts. As always, that is the end of the content. If you have enjoyed today's episode, do hit that like button, do subscribe and hit the bell to be continually notified of these episodes as they drop. And if you do want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio, do click on that pinned comment below where you can grab a copy. And if you also want to join us in the Discord, do click on that Patreon link below. As always, drop your comments below. I'd love to hear from you, whether you are picking up any of these undervalued REITs or whether you have any better suggestions or alternatives for us to review on the channel. As always, have a great day. Catch you on the next episode and take care.